Hi, welcome to Economy and Markets TV. I'm Dave Okenquist, joined once again this week by Harry Dent. How are you, Harry?
Hi, Dave. Good to be back.
Great to talk to you. Now, Harry, the markets rallied yesterday, up nearly 400 points on the Dow. So some positive news there, seeing a little bit of a breakup possibly. And then this morning we got the U.S. jobs report, a bit of a disappointment. So how do you see things from your perspective this week? And maybe what did that move up yesterday mean?
Well, that was an important break, as I was saying in Monday's 5-day forecast for the boom and bust subscribers. That we got two little channels. The last month we've been trading in 1,000 point range on the Dow, and then more like double that back to the June lows and the all-time highs. So we did break out of that first channel, which was important because it could have just as easily broken down. And that means, okay, now the markets are likely to test the highs at near 27,400. But the thing I'm telling everybody is that this time we got to do more than break those highs. We got to remember that megaphone pattern I've drawn out over the last 2 years for the Dow and S&P. We have to break out of that top trend line, which is heading slightly up. So I think it's going to take about a 27,800, maybe 28,000 Dow to really say, okay, we're breaking into this final dark window, strong rally I've been talking about for the last year or so, where we could see NASDAQ 10,000 and Dow as high as 33,000. So this is important. We'll keep monitoring. But right now, one more positive for the upside near-term scenario rather than the sharper correction. So that's a good sign.
Now, what about just sort of fundamentally? And I mentioned the United States putting the jobs report out was a bit of a disappointment. Those sort of we're not people aren't screaming recession fears quite this week as they were as weeks past, but still there's those concerns. Of course, looking around the world, economies are slumping. I think I counted about 20 central banks that have lowered rates this year. So, what are you watching, sort of the bigger picture globally?
Well, it's slowing everywhere. I mean, the big thing this week, I'm keeping an eye on Australia because I'm going back there for a second tour in the second half of November. And, housing has been leading the world crash there, but there's been a little bounce and people saying, oh, maybe it's over. And I'm like, no, 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 no. Australia came in second quarter at 1.4% versus our 2%. Now, that is really saying something because Australia's demographics are way better than ours. And ours is better than most other developed countries like in Europe or Japan. And so, they didn't even have a recession in the great financial crisis of 2008 and 9, and their real estate barely went down. But they are leading this one. And so even Australia, and China's hurting more than just 6% growth. I mean, with these tariffs and stuff, they just control their figures. So everywhere I look, Germany's, falling into recession again. Italy already did. US, I mean, again, we had big tax cuts and the Fed's gotten more dovish and started to cut rates and really does look like they're going to do more, even if they don't do it quite as fast as the Donald wants. And we're back to 2%. I mean, what's the third quarter going to be? If that's lower than that, then it's showing that there is a diminishing returns to stimulus, that I've been saying for many years. But the stimulus has been so strong that it still had an effect. But now it's just showing they're running out of ammunition. And so it's pretty clear that sometime in the next year, we are going to fall into a recession. The indicators I'm looking at that are not the normal ones, like I've been throwing in a housing construction index and RV sales and things like that, retail and financials underperforming. I talked about this last week. These are all pointing towards like early to mid 2020. But, we still got to watch what Donald does. Donald is going to come up with some reaction to a slowing economy, and we'll have to see what he gets by Congress and the Fed. He's going to start trying to send money to consumers this time. So that's the wild card. But I'd say even with that, by late 2020, early 2020, we're in a recession for sure, and the greatest crash of our lifetime is going to begin. I still lean towards the earlier scenario that we're going to see it early to mid next year. So we'll see.
Excellent.
But good sign this week. I'd rather see the markets go ahead and blow off strongly and get this over with. To me, I know it sounds crazy to people, but the sooner we have this crisis and get it over, the better. I wish we'd have done it in 2008 and 9. We would have been over the worst by now and been in a much better position.
Thanks so much, Harry. If you want to send Harry a question, we can read them on the air. If you got a market question or anything about the economy, send those to TV@economyandmarkets.com. For Harry Dent, I'm Dave Okenquist, and have a great trading day.